Welcome to the Future Ventures podcast on Scaling with Clarity. Today's guest is Sam Hasty, partner at Active Impact Investments, Canada's largest climate tech seed fund. Sam is a Fulbright scholar, investor, and board member who focuses on infrastructure and carbon solutions innovation. His investment experience spans sectors including energy, logistics, agriculture, advanced materials, and climate resilience. At Active Impact, he works with early-stage founders building scalable businesses designed to address some of the world's most urgent environmental and industrial challenges. Sam, welcome to the stage. I'm super excited for today's conversation, especially because climate continues to be an urgent need for us as the world to solve, but it seemed to have waned a little bit in its kind of luster. So I'm looking to get your perspective. But before we jump into kind of like who is Active Impact, tell me, who is Sam Hasty? How did you come to venture?
Yeah, I appreciate the question, Maxim. I've got a weird path to venture capital.
Okay.
I started my career teaching 7th grade math.
Okay.
And I really enjoyed teaching. I miss it even today. I taught for 5 years. I taught in a city in Memphis, Tennessee. I don't know how well you know the state of Tennessee or the city of Memphis. It's the home of Elvis. What is most best known for. But it's a really interesting place economically. And the reason I bring that up is while I was teaching, it became really clear to me that some of the underpinnings of our school system are not preparing kids for the workforce of tomorrow. I'll just spend a minute on this because I think it's a particularly interesting topic. In 2001, there was legislation passed in the U.S. called No Child Left Behind. It might have been 2003, early 2000s. No Child Left Behind was passed. And the idea behind it was basically any education institution that gets public funding, K through 12, should hold teachers accountable. And the way we hold teachers accountable is by testing students at the end of every year, starting in 3rd grade, starting at 8 years old. And so the idea is we can test the kids at the beginning of the year, and then we can test the kids at the end of the year, and we can figure out how well the teacher did. Like, is the teacher teaching effectively? So like intuitively, that makes sense. The problem is if you have to grade millions of tests in time to make an assessment on a teacher before the next school year, those need to be really easy and quick to grade. So the only like test type that works is a multiple choice test.
Yeah.
Right.
Yeah.
Now, here's the problem with multiple choice testing. It promotes something called convergent thinking, right? Which means there's one pathway to one right answer. And when you think about the workforce of the 20th century, we were training people to be cogs in larger systems. How can you be one person on an assembly line that does a task repeatedly exceptionally well? Increasingly, those tasks, whether that's a cognitive task like accounting, or legal review, or a physical task like working on assembly line, like those are getting automated away by AI. Right? Convergent thinking is what AI does really, really, really well, and has been doing well. Like algos have been doing this pretty well for a while now. But what we need to promote for people to be ready for the future is something called divergent thinking, which means there's multiple pathways to multiple right answers. And that's really the world we live in. We live in a world of a lot of ambiguity, and there's a lot of judgment calls in professional work now. It's not just like, hey, here's the right answer, just do it. But the problem is, again, going back to this legislation and testing, it's really hard to test like sort of a more Socratic method, right? Like it's tough to test sort of like open-ended, creative, cognitive, compare and contrast tasks. So this was a problem that we saw. And I ended up working with a friend of mine who started a nonprofit that helped students launch businesses in Memphis. And there's lots of programs that do that. This wasn't created to build the next Microsoft. What we did was we built an accelerator program. We invested in each of these businesses. And then the goal was to build some of these 21st century skills and these divergent thinking skills through the prism of building a business. Because there was this really cool research that came out of Yale in 2010 that was showing that when students had ownership over what they're learning, their skills growth and retention skyrocketed. right? And anybody that's been an entrepreneur will tell you that, right? Like when I build something, like
Absolutely.
I learn a lot and I learn it quickly and I hold on to it because I care about it, right?
Yeah. Yeah.
And so that program ended up being very successful. We got very lucky with some amazing students. We ended up getting funding from some big national foundations. We got funding from Steve Jobs' family office, and we started to license it out to a few different areas around the country. And then around the mid 2010s, as the politics in the U.S. got a little bit more complicated, I started to believe that this political divide that we were seeing grow was a result of an opportunity gap between rural and urban. So when you think about Memphis is a really interesting place because it's a dense urban city, with almost 1 million people in the urban core and then over 1 million people in the metro area. But if you go 2 hours outside of Memphis into northern Mississippi, you're in like one of the poorest parts of North America, right? Like it's a pretty intense place to live. And those rural areas are seeing brain drain like faster than anywhere else.
The urban
right?
areas. Yeah.
And the other thing that's interesting about globalization and the rise of sort of like our internet economy is like when you think back 40 years ago, if you bought groceries, that money had to stay in your community. You went to the local grocery store, you paid your local grocer for the groceries that they sourced. Now you can buy groceries on Amazon, right? So like the money is flowing outside of these areas and these communities faster than it has. So basically, my Fulbright was focused on, okay, how do we research the money, like to take what we were doing successfully in urban areas with some of these like skills development and business building skills into rural areas. And I went to Poland. Poland's a really interesting place for a bunch of reasons. I've talked for a while, so I don't know if I should go too deep down that rabbit hole. But the short version is Poland had a really successful education reform in 1999. A guy named Miroslav Hanke took over as the Minister of Education, and they went from one of the lowest performing countries in the OECD in terms of education quality to top 5. And then all these really skilled Polish workers started leaving, right? Like they would get educated in Poland, they'd get a great education, and then they went to Germany, and then they went to the UK because there were higher wages and more job opportunities and more like big multinational companies. And then the Polish government basically said, we don't like that, right? Like we want to keep our talent here. So in 2015, a guy named Lucas Duda was elected president, and they really focused on entrepreneurship in Poland. So they were taking some of the funding they were getting from the EU and driving it towards entrepreneurship programs. So I went to this tiny little town in northwest Poland called Koszalin. It's about 4 hours east of Berlin, just to give you an idea of where the city is. And I was researching, like, are these programs helping to start businesses? Like, is it working? Are people, and as part of that program, I got to go to startup competitions all around the continent. Fulbright basically, I had a budget to go to these different conferences, and I started to see really cool startups in the impact space. And so I started to send deals to family offices and foundations that had supported my nonprofit because they cared about impact and they were doing some impact investing. And I would say, hey, I don't know anything about this, microgrid company in Uganda, but you like this stuff. Do you want to take a look? And as they started to invest, I would write small angel checks alongside them. And that's how I got into angel investing, and now I'm in venture capital. So that's a long-winded answer, but that's my very weird, windy path to the seat I sit in today. And I've now been in venture capital for 8 years.
Love it. I mean, this is an unusual story, but it's definitely a story driven out of passion and interest and purpose. You were already doing the work, so you just kind of become a natural evolution of what you were already doing. If you started in venture capital, I'm assuming that Active Impact is your company. I'm assuming that you're emerging fund manager. Kind of like how easy or hard was it to raise the first fund, or was it because you already you had a relationship with a lot of family offices, a lot of investors through the foundation, the not-for-profit, that it was like, hey, you already know who I am, you know what I'm capable of, write me a check.
So my partner, Mike Winterfield, founded Active Impact.
Okay.
So I joined Mike about halfway into the first fund. It was a $10 million fund that he'd raised. And I joined him and our other partner, one of our other partners, Tom Bodez, at the time. And in terms of that, like the first fundraise process, the first fund is always a grind, right? Like it's a battle. I think Mike's better suited to talk about how
Yeah.
deep the battle was. But I'd say there were a couple things that I would credit our team for in the first
Mm-hmm.
fund. One
Mm-hmm.
is Mike comes from he has a recruiting background, but as he grew up in recruiting, he ended up becoming president of Canada's largest recruiting agency.
Okay.
And as he rose within, and that actually turns out to be a super valuable skill set in venture capital. So we'll talk about that
Absolutely.
later. One of the first things any of our founders do after we invest in them is hire people, right? So like
Mm-hmm.
Mike's been involved in thousands of hires. So that sort of like seeing around corners and what to look for in some of those early hires is a really valuable,
Mm-hmm.
you know, expertise set to have for our early stage founders. But as Mike grew up in that recruiting organization, he started to get more involved in the sales side of the organization and was leading very large sales teams in this recruitment business.
Mm-hmm.
A fundraising process is not dramatically different from an enterprise sales process. You have to build the right
Mm-hmm.
volume of funnel. You have to manage the funnel effectively. So that was a great skill set on one side. And then my other partner, Tom Bodez, he was the managing partner of one of the most well-respected tax law firms in Canada. And the interesting thing about tax lawyers is it's very complex legal work. It certainly attracts a certain type of lawyer.
Mm-hmm.
But once you get to a certain level of expertise and recognition, you start to know where all the money is, right? Like you
Of course.
and
Those are the
and
people that need the legal help.
and so when you put like a well-run enterprise sales process and leader,
Yeah.
someone who knows where that money is, it's a
Yeah.
pretty good combination, even when raising a first fund is really, really
Yeah.
hard. And so I got much more actively involved in our second fund's fundraise, which was an oversubscribed fund we raised in 2021. And then we raised our third fund in May of this last year. It was a $110
Oh, nice.
million fund. Yeah.
Wow. Wow. Oh, so you went from 10 to 110. What was the fund to in the middle?
60. So the target was
Okay.
50 and our hard cap was 60. We hit our hard cap of 60. Actually, I mean, 2021 was a crazy time, right? So
Yeah.
we launched our fundraise. I think it was January 4th of 2021 for the
Yeah.
second fund.
Yeah.
And we closed on, I want to say 42 million. It was 41 or 42 million 7 weeks later.
Oh, wow. Wow.
Like this, it was a very, very different world. That was a really expedited process. The whole thing was oversubscribed in 6 months.
Wow. Mostly
And so,
institutional LPs?
excuse me?
Mostly institutional LPs?
No, so the first fund was pretty much, I mean, it was evenly split between high net worths, family offices, and foundations. But the truth is,
Mm-hmm.
all three of those are basically high net worths, right? So like
Yeah.
the first one was pretty much all high net worths that had their own decision making power. There wasn't a lot of investment, intense investment committee approval. The second fund was that first 42 million was filled almost completely with individuals, high net worth family offices, and mostly repeat from our first fund. But then the last chunk was taken by a few institutions.
Okay.
And so this third fund that we just closed in May of last year, May of 2025, that was the first fund that we've had that was anchored by institutions. So they were the first commitments in. There was a pension fund in Quebec, and then a fund of funds in Toronto that were the co-anchors for our third fund.
Fantastic. So we went in 50 million increments. So I'm assuming the fund 4 is going to be at least 160, if not higher.
Well, it's interesting you say that. Actually, I think you talked about climate tech losing some of its sexiness in the last couple of years, right?
Yeah.
So I think there's a really important conversation every GP needs to have with themselves, which is what's the ideal fund size for me to be greedy with carry and not with management fees? And I'm not just saying this, like, I think 110 is the right number for us. And the truth, and part of that, like, I have lots of belief in climate and we can talk about that. We have not yet seen evidence of $10 billion outcomes in climate. Right. And so if once you start raising $300 million or $400 million or $500 million, the outcomes you need to triple that fund start to get bigger, right? That's just the basic fund math. And so I actually think fund four, if I had my druthers, like I think fund four is going to be pretty similar to this size, because this is by far our highest performing fund so far.
Yeah.
And it seems like a really strong sweet spot for us so far. So we'd have to see something change to convince us that like changing the number makes a lot of sense.
Sam, what makes Fund 3 the highest performing fund? Is it that you guys have a lot more rigor, higher deal flow, quality of companies, the climate tech companies, or have evolved significantly in terms of technology? Kind of like what's driving the higher performance?
In a sentence, it's founder quality.
Okay.
And so I think we've always had the ability to assess founders really effectively. Like one of the cool things about Mike's experience in enterprise recruiting for 15 years, he's actually built up his own proprietary system for assessing a couple of key variables that we see as pivotal to founders. So there's this really interesting 2x2 that we put every founder through, which is a matrix of intelligence and accountability. And there is a very common pitfall in hiring and investing where people end up investing in high intelligence, low accountability people, because those people are the most sophisticated at tricking others in the interview process, in the diligence process, right? And it's not, I'm not making these people out to be frauds, right? Like it's not ill-intentioned. It's just like there are ways over a series of conversations that we have where we ask the same exact questions to every single founder over this period to get a sense. And you can actually pull out some really interesting insights on intelligence and accountability. So we ask like very basic questions like, have you ever taken an IQ test? How is your intelligence compared to others, like numerically, quantifiably? What are some examples of that? Like we did things like SAT scores, literally, like just to understand, like just from a strict quantitative perspective, what does your intellect look like? How are you learning things and how quickly you learn them? But then the accountability piece is really an interesting point, right? And I think where this is getting more momentum recently, which is really good, the value and importance of references. Right? Like you get so much more from 10 references than you do from 10 conversations with the same person. And so one of the rules we have is in the process of diligence, we ask founders for quantifiable accomplishments that they've had in previous roles. And then we seek in these references, will anybody else say this independently without prompting? Like if I don't say like, hey, Maxim said he took the business to 50 million ARR. Is that true? Because like that puts the reference in a tricky spot. You just say like, walk us through every accomplishment you felt Maxim was able to accomplish working with you. And tell me what would have happened if Maxim wasn't there, right? Like if Maxim was gone, how would the outcome have been different? And so that combination with the sort of strategic questions we have can pull out some of these things. Anyway, so I think the reason I bring this up—
Can I just double click on the 2x2 matrix? Because I'm curious. I mean, like, do you place equal weight on intelligence and accountability? Like, I mean, at the moment, high agency is so highly regarded and valued. And in essence, it's accountability, doing the things you're going to say you're going to do and finding ways to do them. So you place equal importance on both.
Yeah, we place equal importance on both. And I'll tell you, like, the magic in this is not just saying intelligence and accountability. It's how do you ask the right questions that don't lead the witness, right? Like high intelligence people by definition can think through what the answer the other person wants to hear is. So you have to come up with creative questions. So I'll give you a really weird example that we're brainstorming right now. If I were to ask you, how does someone catch a cold? What would you say?
I mean, cold is a virus, so it's transmitted perspiration, droplets. That's what I'm assuming that is the answer. It's not. I mean, it's not the old wives' tale of like, you sit in a draft breezy place and you catch a cold.
Yeah. So that's there is no right answer, just to be clear, right? Like what we are looking for is data points. I'll give you extreme examples on either side. On one hand, you'll hear someone say, I was on a plane and this person was sneezing next to me and like, I got it from them. And, and that's how you catch a cold. You just like sit next to someone who's sick.
Yeah.
And you have someone else who says, actually, like, if I have 3 or 4 days in a row where I'm not sleeping enough and I'm not taking my vitamins and I'm not taking care of myself, then I expose my body, like my immune system's
Yeah.
compromised. And
Yeah.
and both are true. Like the point isn't to say there's a right answer. The point is you can actually pull out a little bit of someone's thinking about their own agency in their life,
Hmm. Hmm.
right?
Hmm.
And
Hmm.
like that ties into accountability here, right? Like
Hmm.
how much because then you fast forward 5 years and you get founders that say, oh, my investors just don't get it. That like they should be giving me more money. They're not giving me more money. It's
Yeah.
their fault, right? And like
Yeah. Yeah.
that's get really tricky because we've had good businesses where you have a founder that has that mindset and then you get a suboptimal outcome,
Hmm.
right?
Hmm.
So that's really the magic of that. Is the question framing in a way that doesn't give away what the right answer is? Because you're a super smart
Yeah.
guy, and I think you didn't. It wasn't immediately obvious to you. Like, what's Sam trying to get at by asking me how someone catches a cold? Is he looking for my
Yeah.
intellect? Is he trying to assess? Do I understand how viruses work?
Yeah.
Is he? But going back to your first question about what's changed for Fund 3,
Yeah.
I felt we've always had a pretty strong radar for assessing founders, but um, I'll tell you one thing that's different for us, and this ties in
Hmm.
directly to getting access to better founders. Our first fund is only 15 companies. Our second fund is only 17 companies. They're very
Okay.
concentrated funds for seed stage, right? Like common wisdom is at seed, you should be getting 50 to 70 shots on goal because that's
Hmm.
what you need to get access to a unicorn, to get to sort of like
Hmm.
power law upside.
Hmm.
Um, we are very active post investment. I'll tell you, there have been several times where a company's been in trouble and no one will write a check, and we're the only one who writes a check.
Hmm.
I don't
Hmm.
want to say we write a check every time in every bridge because that's not the case, right? But we really like to fight with founders to the very end, right? Not what I mean
Yeah.
by that. Like we
You're
want
in
to
the
stay
trenches.
alongside them. Like we have an example of a portfolio company just in the last quarter where they were struggling to raise money. They had seen some growth, but not aggressive growth. So we worked with this founder to cut headcount to get the company to cash flow positive, which is a painful process. You know it. Everybody hates doing that.
Yeah.
But we got aligned. We supported them in the HR process of like terminating a big chunk of
Hmm.
the staff, doing a meaningful riff, and then we financed out of our pocket a new hire that was a president to work alongside the CEO. And since then, we've seen revenue growth increase, and they just got a term sheet for a $4 million round.
Nice.
So I'm only saying that to say no one else was willing to write a check there. And we
Hmm.
said, we'll write a check, but it's got to go to this specific hire because this is the
Yeah.
hire that we possess that will change the
That's the
trajectory.
gap. Yeah.
Right. And so how that ties into better deal flow in Fund 3 is we are now seeing when we get into competitive situations now, and
Yeah.
I talked to a founder who's on startup number 4 and has sold
Yeah.
a business for 500 million bucks before. I can say, stuff gets hard. You've done this before. Like
Hmm.
there are some deep, dark moments in
Hmm.
the venture building process. Go talk to one of our founders that's having a hard time. Ask him how we show up. And that reference wins us better founders now than we were
Yeah.
able to get access to in Fund 1. And
Yeah.
so we have 5 founders. We've made 13 investments so far. We have 5
Wow.
founders that have an exit for at least $100 million in this fund.
Okay.
And so
Wow.
that's been the biggest delta in terms of the increase in revenue.
For the second fund, for the third fund, what's kind of like, I know there isn't necessarily a target, but are you going to cap out at 20, 25
Yeah.
investments?
Yeah. Right now we're looking at between 20 and 25. We believe we need to go slightly broader than the 17 we did in Fund 2. But we
Hmm. Hmm.
still, what's most important to us is that we're still able to be very active when things
Yeah.
get hard, right? And so you can only do that with a certain number of companies. You can't be very active when things get hard with 50 companies. It doesn't work.
How big is the team? I mean, obviously, I heard three GPs, 3 partners, but how big is the rest of the team?
Yeah. So we now have 4 partners. Sophie on our team
Okay.
was promoted just a couple months ago. So we're thrilled to bring her into the partnership. And then we've just added 2 more people. So we're 9 full-time with a part-time person as well.
Okay. Fabulous.
Sorry, 8
And,
full-time and 2 part-time people. 10 total, 8 full-time, 2 part-time.
and that feels like just the right size for you guys.
Yeah, right now that feels like the right size. It's always a tough balance. What we did in Fund 1 and Fund 2 was all of us basically took
Yeah.
effectively lower pay to expand the team so that we
Yeah.
had a team that could handle the next fund size.
Yeah.
So like
Makes
when we
sense.
were raising the 60, we had the team in place before we raised it to deploy the 60. When we were raising the 110, we felt the same way. Now we actually feel quite like as I said, we think this is a good number for us and a good fund size. So we feel like this is the right size team for what we're doing into the future.
Have you seen any kind of shift or in terms of expectations from Fund 1 to Fund 2 to Fund 3 in terms of kind of like what the investors in the fund are expecting, what it's reporting or outcomes, returns, focus, anything that has shifted from Fund 1 to Fund 3?
Yeah, I mean, I'd say there is. I think it's pretty similar, right? Like at the end of the day, our investors want top decile returns from our funds, and we're going to continue to drive towards that. And they want a meaningful, quantifiable environmental impact on climate specifically. So our North Star is emissions reduction. Our target for this fund is to reduce 10 million tons of CO2. Now, for context,
Direct or indirect?
can you tell me
direct?
Go deeper on that question? When you say direct or indirect, like what's an example of direct versus indirect?
I mean, emission reduction for me is like either carbon sequestrations or like something that prevents the emissions from occurring in the first place.
Yeah.
Indirect is like maybe you're sequestering, but it's the steel reduction, or you have technology that drives awareness around kind of the footprint, so it makes companies forces different behaviors on the part of emitters, kind of like, so if I was to take this into scope 1, scope 2, scope 3 kind of emissions.
Got it. Okay, so I'm going to answer the question. We look at impact. We have 3 different buckets that when we initially diligence a company can fall into, right? So one is direct quantifiable impact. So as an example, one of our Fund 3 companies is a company called Rototherm. They do EGS, enhanced geothermal systems. So it's a closed loop system. It's the first waterless geothermal system, which is very exciting for a bunch of reasons. That is a direct impact on the emissions profile of the grid because every electron they produce is a zero emissions electron.
Yeah.
So that is immediately bringing down the carbon intensity of your grid, right? Also, I said EGS, it's AGS, sorry. There's enhanced geothermal and advanced geothermal. They are advanced geothermal. Fervo, which is going public, which you might be tracking, is enhanced geothermal. We don't need to go get to do that.
Yeah, because on the enhanced side, we work with a company and they use water and they strip out rare earth minerals or from the water circulation.
Yeah.
Okay.
And there's some really cool applications for enhanced geothermal. I'm really excited about what Fervo's doing, and I look forward to seeing them continue to grow. We could talk about Rototherm in a lot of depth. There's some really interesting reasons that investment makes a lot of sense for us. But the reason I bring them up is just like that is a very clear direct emissions impact on the grid the second they're producing. And we quantify it. It's something like 800,000 tons for their first 100 megawatt facility. And then so bucket 2 is an enablement layer. So I'll give you an example. There's a company that we just invested in called Peak Energy. Right now, 90% of the interconnection queue, so projects waiting to be connected to the grid, are renewables. This is a platform that helps expedite permitting and effectively it expedites the process of working through the interconnection queue. And all their customers so far are renewables customers.
And this operates across all of Canada, Peak Energy?
Peak Energy is in the US.
Okay. Oh, sorry. Okay.
And so the reason I bring them up is that is an impact that we feel clear about and aligned on, but that's really hard to quantify because you say, okay, you speed up, let's call it 100 megawatt utility scale solar facility.
Mm-hmm.
And it gets connected 6 months faster than it did before. Like, how do
Yeah.
you quantify that? You can quantify it, but there's a bunch
Yeah.
of assumptions, right? And it starts to
Yeah.
get clear. So the enablement layer is bucket 2. And then bucket 3 is, we believe in this impact, but quantification is kind of impossible. So
Okay.
an example of that company would be something like Metafold. So Metafold is a company, it's a group of PhDs out of the University of Guelph that have created this topology optimization engine that creates lattice structures that have the same structural integrity. So basically, you can use 90% less input material and have the same structural integrity because their materials have a bunch of holes in it, right? So it's like,
Mm-hmm.
how do I create this like porous structure for a structure that used to be just like solid metal? And I can lightweight a bunch of stuff too. So like a Ford F-150 Lightning, which has been discontinued, unfortunately, like that's almost 2,000 pounds more than a regular Ford F-150 because the batteries are so heavy.
Yep.
So you say, okay, that means we need to lightweight other stuff in the truck to make, like to enhance range.
Mm-hmm. Or lighter batteries.
Exactly. It has lots of applications for things like electric, like dump trucks, right? And electric 18-wheelers and a lot of aerospace applications, this lightweighting with the same structural integrity. So that's really cool. And we believe there's a meaningful emissions reduction potential for a business like that, but we're never going to be able to quantify it. Right.
Yep.
And so when I talk about that 10 million tons, that is just in bucket 1, right? Those are just the companies where we can quantify clearly the emissions that this company will reduce. But we also make other investments where we believe the impact is very clear, but we also acknowledge to ourselves and to our investors that quantifying that is tricky.
Mm-hmm. Makes sense.
Yeah.
What I kind of want to go back to my initial statement. I think that this is really important work. There should be more of it. There should be more innovation. There should be more investors underwriting this innovation. But at least from my vantage point, I've seen less interest in investing in climate tech. Is this a fair observation or not?
Yeah, I think it's a fair observation. I'd love to put the question back to you. Have you done any investing in climate tech directly? Like how well would you say you know some of the underlying technologies in the ecosystem right now?
Probably not well enough. I'm an advisor with a climate tech company here out of Calgary called Arbor, and
Yeah,
Arbor.
that's cool.
Oh, fantastic. Okay, so you know what they do with life cycle assessment, product carbon footprint assessments. They do the calculations all the way from scope 1 to scope 3. Really cool company. I used to be responsible for ESG assurance at Parkland Corporation, which was recently acquired by Sunoco, as well as at Husky, which was acquired by Synovus. So from that perspective, I know some, but I can't say that I'm an expert in ESG and climate.
Yeah, it's interesting you mentioned Parkland. I just met Bob Espy. Did you and Bob ever cross over at Parkland?
He was sitting, that was the former CEO. He was sitting 3 cubicles away from me.
Unbelievable. Small world.
Yep.
Yeah, no, Bob's doing some really cool stuff in clean tech right now, actually.
Interesting.
We spoke because he's focused, he's getting more active with a company called EN Zinc, which is a new battery chemistry that's quite interesting.
Okay.
So you know the space relatively well, right? Like, I mean, I think you can speak intimately to this. I would say from a venture capital perspective, you're right? Like the early stage and sort of more importantly, that sort of Series B stage financing for climate has taken a hit over the last couple of years. And I'm happy to, pull up the data even on the screen if you want to look at it, but the data is pretty clear on that. What's interesting though, is that we are in a very interesting time for infrastructure. And there are climate technologies that are now getting access to infrastructure finance that is actually skyrocketing the number of dollars, like net dollars going into these technologies. Fervo is a great example of that, right? Like they're listing publicly kind of as we speak. But I can list a dozen companies right now that are getting multi-hundred million or billion-dollar project finance facilities from organizations like Brookfield and like ClearGen and like, these different financiers that specialize in renewables. And those dollars in terms of total dollars available are significantly larger than the amount of venture capital dollars available. And so all that's to say, from a venture perspective, yes. But this actually goes back to why we made an investment in Rototherm. I'm sure you've heard of the Valley of Death, right? Like you build a pilot and it works, but getting through to a commercial scale facility where you can actually like access non-dilutive competitive rate of return capital, like true bank financing, like true bankability, that's a big gap. And in 2021 and 2022, our ecosystem funded a lot of founders that had built something cool, but those founders were not proficient in
the commercialization.
Well, I can't tell you how many times I've heard, once I build the first one, everyone's going to want to finance it, right? Like I'll build the first one and then it's rinse and repeat. That's not how debt financiers think. It's not how they should think, right? They're very risk averse. Every project is a snowflake. I don't care how modular you are. I don't care how repeatable you say you are. Like it's in a different region. It's in a different place. There are different inputs, different workforce. And so Curtis is an exceptional example of someone that we bet on because he had built 2 very large fracking businesses. So the skill set was similar in terms of drilling, but more importantly, one of those businesses attracted over $500 million of non-dilutive capital, of debt financing. And so he knows how to think like a debt provider because he has serviced debt, large amounts of debt over a long period of time. And that is super important for early stage equity investors. Because if we have to finance all this stuff with equity, we're going to get crushed from a dilution perspective, right? And so it's not just that like it might be harder to get capital at Series B because there's not as much of it. Like that matters. But more importantly, even if it works out, it's tough for us as early stage investors if we get diluted like crazy from all the equity, even if the equity does write the check at Series B. So we're increasingly working with founders to assess their fluency in project finance and in non-dilutive capital. And if they're not fluent in it, that's okay. But just like there's got to be a plan, because if the person at the top, if the CEO is not able to speak the language of a debt provider, it's tough to like embed that in the culture, even if you hire a great CFO one day.
Yeah. But I mean, in many ways, this is extremely, there's a almost like perfect alignment between the early stage investors and the founders, because they have no interest in getting diluted. So focusing on commercialization, focusing on revenue, focusing on venture debt it's in their best interest because they get to keep a bigger proportion of the company.
Yeah. Venture debt's a tricky topic. Like let's put it in the venture debt point you made. But the other ones are so true. I think what's tricky about climate tech though is that there are some technologies that can't get revenue, any meaningful revenue, revenue to cover their costs in the first couple of years, right? Like if you're building an SMR, it's hard to get revenue that covers all your costs in the first, 48 months, right? Like so that's where I think a lot of people have run into challenges in climate tech. And so we try to either find businesses like Jetson is an example in our company. They're a heat pump business. And it's the fastest growing company we've ever been a part of. We invested in 2024. They started selling heat pumps at the end of 2024 in Q4. As of this last quarter, their run rate is at $100 million. They're selling, that's in 18 months. That's without any, that is not inorganic growth. That is building a vertically integrated business that had strong unit economics from day one and could sell right out of the gate. But then there are other businesses like Rototherm that are going to take some time before those projects are built. So if we're going to invest in those, we need people that really understand the path of lowering the cost of capital over time.
And is this one of the biggest challenges to why more companies, more climate or impact companies are not getting the funding they need? There's a significant upfront investment to get to the point where they're commercially viable and sustainable, self-sustainable.
Yeah, but I think it's actually deeper than that. I think
Okay.
that's a point. I think the deeper point, though, is evidence of significant exit outcomes and capital returned to LPs.
Mm-hmm.
Like and this is where, as a venture investor, it's our job to look forward more than it's our job to look backward, right?
Mm-hmm.
So I think this is part of why we're so bullish on investing in climate right now, is the demand for some of these technologies is so significant that we think decacorns are coming, right? Like
Yep.
Fervo's IPO listed price, I think, is around 7 billion, right? So you're flirting with the decacorn status there.
Yep.
And we've seen, other companies in the nuclear space like Oklo, list on public markets and get, very receptive audiences. And
Mm-hmm.
so I think the deeper problem is, for many technologies, it is still on the operator, the CEO and the founding team, to tell a compelling story about the upside. Because that's what
Mm-hmm.
all of us are after, right? Like, all of us are about upside. OpenAI raised a ton of money before it was generating significant revenue, right? Like, I don't think it's just a revenue issue. Like, it's not like, oh,
Mm-hmm.
we need revenue faster. I don't think that's the only problem. I think the deeper problem is more people, because they have to see to believe, need to see evidence
Yep.
of the person next to them making exceptional returns, investing in some of this stuff before they say, okay, like, I got to put my money in this too, because I'm falling behind.
That makes sense. Um, Based on kind of like what you've observed so far, do you think that the next decade of climate winners will come from software, infrastructure, industrial innovation, deep tech? Kind of like Jetson is a hardware company. Kind of like where do you see um, the biggest winners coming from?
Yeah. I want to answer that, but before I do, I'm curious your answer to the last question I gave, right? Like, you asked me about how the funding landscape is
Mhm.
changing. How do you think the landscape in climate is changing?
Um, I would completely agree with you. I mean, we recently had a conversation with a climate tech company out of Singapore, and the pivot that they had made was to shift away from product revenue to services revenue until they build out this. It's not from my perspective. It's not a matter of if; it's a matter of when. Um, we had a conversation 2 weeks ago with a really important climate fund out of Switzerland,
Mhm.
and very well researched with a whole bunch of PhDs. And so everything now is predicated, instead of like 2 degrees of warming, of 4 degrees of warming. So kind of like, what does this mean? How are we going to drop down, like manage to this level? And what is the impact, the downstream impact of now, hey, the Paris Accord, we were like trying to cap at 2. Now we're trying to manage at 4. What does this mean? So I think it's
Yeah.
like we have no choice. We just need to find ways to get to market faster, to make it more commercially viable. To your point, have
Yeah.
more successes, because it's the same thing. Like I'm based out of Calgary, and so we've had lots of conversation around how do we build a thriving ecosystem in Calgary, and there's been a lot of energy. And
Yeah.
so I was working with Eric Midisek, who is the community architect for Techstars. And so we're kind of looking at Techstars and their most successful communities, being Boulder, Colorado being number 1, New
Yeah.
York being number 2, Seattle being number 3. And the key there, based on, again, Techstar has 265 startup companies that have invested in Canada. And so what they're seeing is where you start to see success is where you start to see exits, where you start to see other companies scale, where you see the stories where you can relate to, and that's kind of like what drives the momentum. So to your point, if we start seeing some of this happening,
Yeah.
investors are going to flock in,
Yeah.
especially if they see that the returns are equal or better than what they can unlock in other industry verticals.
Yeah. Yeah. No, it's a really interesting time. Um, and I think Calgary is actually a really amazing place for innovation right now, for
Agreed.
a whole bunch of reasons. I know we could go down that rabbit hole. Um, but you mentioned a question about what types of businesses will win
Hmm.
over the next 5 to 10 years? Is it hardware? Is it software? Is it services? I think this is a question every venture investor is wrestling with, not just climate investors. And some of the very successful AI companies like Anthropic, like investors in that company, are wrestling with this as well, because they are increasingly becoming infrastructure businesses, right? Like Meta is building out huge infrastructure. AWS is building out huge infrastructure. And so these businesses are not strictly software, 90% margin SaaS businesses anymore. And everybody's talking about SaaS apocalypse. So I think the question is, where are you identifying large share of wallet, and where are you identifying hair on fire problems? And that's where the biggest returns will come from. I know it sounds like a basic answer, but I think we're going to see lots of AI-enabled services businesses do very, very well, right? We're seeing lots of these like roll-ups that have an AI foundation get real momentum and get lots of venture funding right now. And I think those businesses that business model has a chance to be very successful. So I'm pretty bullish on AI-enabled services over the next several years. And some of our portfolio companies are actively engaging in that and winning in that by taking that larger share of wallet. Because in many cases, the budgets to people for services are much higher than the budgets for strictly software. I think we've seen we continue to watch climate software closely to see what exceptional looks like. We haven't seen lots of evidence of like a climate software just blow the doors off. And actually, one other point I want to make on this, which is related to the point you just made. We go back to these problems that are really significant. There's a company called Pano AI that's doing early detection of forest fires. So they strap a little widget on a piece of infrastructure, and then they use their machine learning to say, like, there's a fire there before anybody knows it in 10 words. Last year, they raised $50 million on a very aggressive pre-money. I don't think I should share exactly what the numbers are. I'm not in the deal, right? But like, I'll just say the multiple, and this is a hardware business, right? Like, this is not a strictly software business. They have a software component, but like they have to install infrastructure here. They raised something like a 20x multiple. And there were great investors in that round. That's not an AI company, right? Like, that's not just a hype-based company. That is a company that's solving a problem that is becoming an increasing pinch point for communities all across the western half of North America. So to your point on this 4-degree potential like tipping point now, there will be more problems like that will be solved by solutions that are addressing climate change. And those businesses are going to have appetite from financiers.
If I can offer some input from talking to a lot of climate tech investors, I guess the one thing that they're looking for is like, that's great. Like, we're working with a Calgary-based company that does something very similar to what you described. It's early detection of fire using AI and how to combat them. The one thing that what I'm hearing from investors, and I've talked to climate tech investors all over the world, from Singapore to South Africa to Switzerland to Canada, they are looking for outcomes being driven from the technology. If it's software, that's fine. They want to see the outcome. So just because you calculate carbon footprint, that's great. Go figure out a way to reduce it. So that's kind of the missing piece that I'm hearing from other climate tech investors.
And I think that's what's so interesting about the question you asked, is that it's not whether it's software or hardware or services. It's who can demonstrate outcomes-based value, right? Because a lot of businesses are moving from a seat-based model to an outcome-based model, whether that's usage or right. And so I think we will continue to see that momentum build, right? Like as corporates that are procuring these things move closer to outcomes, it's the business models that can demonstrate outcomes that are well suited to succeed over the next 5 years.
Sam, I could talk to you forever. Any kind of parting thoughts of wisdom? Where can people follow your work? Is it going on the Active Impact Investment websites? Reach out to you on LinkedIn. If an investor wants to pitch to you, kind of how do they get in touch with you?
Yeah. So I'm active on LinkedIn. Yeah, you can find our website, activeimpactinvestments.com. You can reach me at my initials, SH, at theactive.vc. If you wanna connect with me. Maxim, I'm really grateful for the time. I want to pick your brain more on these topics because you're obviously pretty deep on them as well. And so maybe we should do round 2 sometime in the future.
For sure. What I would love to do is I'd love to do a pitch competition just focused on climate tech and just round up 10, 15, 20 most promising climate tech startups and just have climate tech investors score them, give them feedback. No money to be allocated. Maybe we can find a sponsor for it, but I think that would be a really good, really clever idea in terms of driving visibility. Because in some cases, it's visibility because the visibility may create some serendipitous connections or somebody coming and helping the founders.
Well, I'll tell you, Maxim, maybe in collaboration with that. So we just did our first Canadian Climate Capital Summit on Monday.
Okay.
And this was a collection of some of the largest climate tech companies in Canada, many with over 100 million in ARR, a couple with $1 billion of contracted revenue. And the purpose of that was twofold. One, Canada is an exceptional place to build a climate tech company, especially if you're using the systems in the right way. And two, we're really punching above our weight. I mean, of the 25 largest exits in climate tech history, 4 are from Canada. So we make up almost 20% of the climate tech exits, of the largest climate tech exits globally. And so I think it would be really cool to continue to highlight those exceptional stories, but also show them as examples for some of these earlier stage climate tech companies that you're describing, right? So that they can see even just 3, 4, 5 years in the future. You know, some of these companies are companies we passed on 5 years ago, and it hurt me to see them on Monday saying, "Man, you guys are just knocking it out of the park," right? So we should collaborate on that in the future.
Yeah, I looking back on the grid and seeing where did they score low on the intelligence / accountability score.
Yeah, exactly.
Sam, absolute pleasure. Thank you so much for coming on the podcast.
Thank you. I appreciate it. See you, Maxime.